In Chapter 14, we'll be looking at the tax consequences of home ownership. Specifically, the objectives we're looking at is determine whether a home is considered a principal residence, a residence that's not a principal, or a non-residence for tax purposes. We're going to show you how to compute the taxable gain on the sale of a residence and the requirements of for excluding gain. We're going to look at the tax issues and consequences associated with the rental use of a home. Sorry that extra slide is here. We're going to move on. And there it is. Okay. Whether your dwelling unit is residence or non-residence for tax purposes depends on how the unit is used. Dwelling unit is residence. So the structure is a residence if the personal use days, so you use it more than the greater of 14 days of the year or 10% of the number of rental days during the year. Otherwise, it's non-residence for tax purposes. So when you're trying to decide, did I sell a residence, you're looking at these tests. Personal use days include days the taxpayer or other owner stays in the home, days a relative of an owner stays in the home, even if the relative pays rent at a fair market value, days a non-owner stays in a home under vacation home exchange or swap, so like those timeshare kind of situations, days a taxpayer rents out property for less than fair market value. So it's a little bit beyond what you would think. So those are our personal use days. What's a rental day? These are days when the taxpayer rents property at fair market value. Also, days spent repairing or maintaining the home for rental use. So you might have thought, oh, personal use would be if you're staying there, you're fixing it up. No, that's considered a rental day. The days the home is available for rent but not rented out are not personal or rental days. So they're just kind of in limbo. They're neither. So a residence is your principal residence. If it's a subjective determination and it may change from year to year. For a given tax year, for purposes of a dwelling unit, it may be a principal residence, a residence as we just defined but not principal, or non-resident rental property. So first we're determining, is it the number of personal days versus the number of rental days. Let's take a look. In your book, just grabbing your book here. I don't have the current version, but that's okay. Could get you around the page on Chapter 14, page 14.2, 14.3. On page 14-3, when a dwelling unit is determined to be a residence, the taxpayer must determine if it's a principal residence. And here's your determination, because it's important for the tax consequences on certain items like the sale of a residence, how you tax any gain. What makes a residence a principal residence? When a taxpayer lives in more than one residence during the year, the determination of which residence is the principal residence depends on the amount of time the taxpayer spends at each residence, the proximity to the employment, the principal place of abode, living and sleeping, of the taxpayer's immediate family, and the taxpayer's mailing address for bills and correspondence. So that's what we're looking at. Note, a taxpayer can have only one principal residence during a particular year. And a principal residence, as we said, may change from year to year due to those facts and circumstances. So, what kind of tax provisions are there? Well, if you have a principal residence or there's certain items you could see right now, and I'm recording this the day that the House Ways and Means is going to be announcing the new tax law. So this could all change. But as of right now, your principal residence home mortgage interest, a home equity loan you have, the interest, home mortgage insurance, they call that PMI. Okay. Real estate taxes on your principal residence. Any deductions associated with rental use, if any, no. Well, yes, I'm sorry. If you rent any of your principal residence out, I'm sorry. Exclusion of the gain on the sale of the home. Yeah. Forgiveness of debt on home foreclosure. So before 2017, we had that. We talked a little bit about that. If it's a residence, so you own it, but it's not a principal residence, and you own it and you use it more than 14 days of the year, the greater of 14 days or 10% of the rental time. Home mortgage interest, yes. Home equity interest, yes. Home mortgage loan or insurance, yes. Real estate taxes, absolutely. Deductions for any part you use as a rental, yes. Exclusion of gain on the sale of the home. Only, and see the little asterisks, if it previously was considered a principal residence. So you've got to look at the rules there, and we're going to do that. What if it's a non-resident? So it's considered rental. You could deduct real property taxes on a third home, and that's what they're talking about there. That's a non-residence. Now we're going to be talking about rental. You can deduct a lot of these things if it's for the rental portion. Deductions associated with the rental use, and that's what we're talking about there, yes. An exclusion on the gain of the sale of the home, well, if it ever did qualify as an principal residence. So you can see when you have your property classified as a principal residence, you get a lot more tax benefits out of it. Now, the non-tax consequence of home ownership. It's a large investment, of course. It's potential for a big return on your investment. So if you buy a house when the market is low and you sell it when it's high, you have the opportunity to make a lot of return or lose a lot of money. There's also a risk of default if you lose your job. Time and costs of maintenance. Don't get me started. And there's limited mobility. You own the home. You're not going anywhere. You got to sell it to get to the next step. The tax consequences, though, are great, and the government really has so far encouraged homeownership by offering a lot of great tax deductions and exclusions. So when you sell a personal residence, and by the way, those items, those interest items and all we talked about in that great table we just looked at, most of them are itemized deductions. So you do have to be able to itemize your deductions to take advantage of those benefits. And we'll be looking at that more when we look at itemized deductions. But when we sell a personal residence, you're either going to sell for a gain or a loss. And this, because a personal residence is a personal use asset, any loss is not deductible, sorry. But if you have a gain, it may be. When you determine your gain or loss, and you do that just like you do for any other sale of an asset, you're going to look at your amount realized. You're going to subtract your cost plus major improvements. Now, if you ever did take any depreciation on the home, and the only time you would do that is if you used any of it for rental, or you used it for home office. You would need to subtract that from the basis. But then you would calculate gain based on that adjusted basis minus subtracted from your selling price. and you will generally see if you have a gain or a loss. Well, if you have a gain and you're married filing jointly and you both can qualify, and we're going to talk about that. So let's say you're married 30 years. You've lived in the same house for 30 years and you and your wife are still married. Well, you can exclude up to $500,000 of the gain associated with the sale. For any other taxpayer, it's $250,000. If there's any gain above that exclusion amount, it's taxed as long-term capital gains. So you get those preferential tax rates. Now here's the key. You must meet ownership and use tests to qualify for this exclusion. What is the ownership test? The taxpayer must have owned the property for a total of 2 or more years during the 5-year period ending on the date of the sale. So you've owned it for at least 2 of the 5 years. If married taxpayers, either spouse can satisfy this requirement. So if you owned your home during the last 5 years, okay, and you get married and your spouse moves in with you, they don't have to own it too, just as long as you owned it for 2 of the last 5 years. This requirement is meant to prevent a taxpayer from buying a home, fixing it up, and selling it and excluding the gain. So flippers don't fall under this category. They are in a business. The use text, this is the other part. Is it a principal residence? The taxpayer must have used the property as their principal residence for a total of 2 or more years during the 5-year period ending on the date of sale. Now, this isn't saying you've got to use it for 2 years consecutively. When you add up all your use time as a principal residence, it must equal 2 of the 5 years. And if married, both spouses must satisfy this requirement. So if one of the spouses lives somewhere else and they only qualify for 1 year of use, it's not going to happen for you. You're failing this test. So this requirement is meant to ensure that taxpayers are selling homes they actually lived in instead of investment properties. So here's an example. Tyler and Jasmine were married. Jasmine moved into Tyler's home located in Denver, Colorado. Tyler had purchased the home 2 years before the marriage. After the marriage, the couple lived in the home together as their principal residence for 3 years before selling the home to move to Chicago. Tyler was the sole owner of the home for the entire 5 years he resided in the home. Would gain on the sale of the home qualify for the $500,000 exclusion available to married couples filing jointly, even though Jasmine was never an owner of the home? And there's our answer, yes. We talked about that. So ownership, one of the spouses has to own it 2 of the 5 years before the sale. For use, though, they both have to use it for 2 of the 5 years. So it qualifies here. They lived in it for 3 years and Tyler owned it for 5. Okay, so that's how we deal with exclusions of gain. Sorry, I'm kind of looking ahead and trying to think to myself here what I want to tackle next. So that takes us through the first 2 objectives of our chapter. Now we're skipping objective 3. We're going to come back to that when we're talking about itemized deductions. So we're now going to objective 5, which in my book starts on around page 1417. So we want to talk about what happens if we use our home as rental property. So there's 3 different classifications rental property falls into. You have a residence, so not a principal residence here. We're talking about a residence you own for a second home with minimum rental use. So you only rent it out for 14 days or less a year. So 2 weeks or less a year. You own a residence with significant rental use. You rent the home for more than 15 days and you don't use it personally. And then we have non-residents. I'm sorry, let me go back. Residents with significant rental use, and then non-residents, which non-residents is it's a rental property. So we're going to focus on that second bullet in a few minutes. The taxpayer must live in a home for at least 15 days and rent it out for 14 days or less to be in minimal rental. And so basically it's saying that's a second residence. You rent it out for 2 weeks. The rest of the time you're using it for at least 15 days. You're using it for at least 2 weeks of the year. So the rental income is all excluded from those 2 weeks you rent it out, and there's no rental expense. It's like you didn't even rent it. Any kind of home mortgage interest that you pay on this and real estate taxes can be deducted as an itemized deduction. Just like your principal residence. Now, if there's significant rental use, so you rent the home for 15 days or more, personal use is the greater of 15 days or more than 10% of the total fair market rental days. We call this rental/personal. It's both. We include any rental revenues that we collected from that rental time in gross income. And then we take our expenses related to the rental and we have to allocate them. What portion deals with using it as a rental property? What expenses deal or are associated with that personal use time? The personal use expenses, if they're allowed, can be deducted as a mortgage interest or real estate taxes. But you can have more than those kind of expenses, especially when you're renting. You could have cleaning, you could have management fees. Well, the portion of those related to the rental time are deductible. Expenses are allocated to personal use are not generally deductible, there we go, except for mortgage interest and real estate taxes. Expenses to acquire tenants like advertising are deductible in full because that's directly related to the rental. So it's more of those home expenses. Expenses are allocated to the rental use and they're deductible only to the extent of gross rental income. So you cannot create a loss from your rental of a vacation home if it is considered primarily considered personal/rental. You use it more than 2 weeks and you rent it out more than 2 weeks in a year. And you have to deduct the expenses in a specific order. And these are on page 14-19, an exhibit of them. And they're called tiers of expenses. And you're going to see we're going to come back to these tiers when we talk about an office in the home. The 3 categories. The first category are expenses that are deductible without regard to rental activity. So you can deduct the interest associated with the rental time, mortgage interest, real estate taxes associated, and then like advertising expenses to acquire tenants. Those are your first set of expenses. If those expenses are less than your rental income, so the portion you're able to deduct, then you can deduct them all. The next tier are all the other expenses for the rental. Now you remember you have to allocate it, those total expenses between rental time and personal time, but everything except for depreciation. If the rental portion of those expenses do not create a loss, then you can deduct the depreciation to the extent it does not create a loss. Okay, the depreciation that is allocated towards the rental time. Now, what the heck is the rental time? Generally, expenses are allocated based on the number of days used for each activity. So how many personal days? How many rental days? We're not using 365 here. We're saying how many days did I use it personally? How many days did I rent it? The rental If you're trying to allocate the rental portion of the expenses, you'll take your rental days over the total days you used it, personal plus rental. And that's generally how we allocate all those expenses, and that's how the IRS wants to. There is one exception, and here it is. You can allocate Tier 1 expenses based on the number of days in the year. So your mortgage interest and your real estate taxes, if you want, you can allocate between rental and personal by taking the rental days divided by 365. What does this call for? It allows you to deduct more expenses in Tier 2 and Tier 3 without losing the deduction for mortgage interest and real estate taxes, because you can deduct 100% of those mortgage interest and real estate taxes. It's just that part will be in your rental and part will be an itemized deduction. So let's take a look at an example. At the beginning of year 1, the Jeffersons purchased a vacation home in Scottsdale, Arizona for $400,000. They paid $100,000 down and financed the remaining $300,000 with a 6% mortgage secured by the home. During the year, the Jeffersons used the home for personal use 30 days and rented the home 200. So they're in a personal/rental. They received $37,500 of rental income and incurred $500 of rental advertising expense. How are their expenses allocated to the rental use under the IRS method? And that exception I just talked about is called the tax court method. And either are acceptable. This has been out there, 2 different ways of allocating mortgage interest and real estate taxes for years. And nobody has resolved this issue. So this is in your book. Around page 14-20, this example. So let's take a look. There's their advertising. So their first set of items that they can deduct are Tier 1. So under the IRS method or the tax court method, all $500 is deductible because it's a direct rental expense. The next items are interest and real estate taxes. So calculate your deduction under the IRS method, which says take the number of rental days over the total number of days. So 18,000 times the fraction 200 divided by 230. You get 15,652. The same with the real estate taxes. So under the IRS method, Tier 1 expenses that are allowed as a deduction for the rental portion and can be subtracted from your rental income, $20,500. Tier 2 expenses would be your utilities, repairs, insurance, maintenance, everything else but depreciation. Now, whether you're using the IRS method or this tax court method, you see the amount you're allowed as a deduction is computed the same way. You take each one of those items times the number of rental days over the total use day. So those total Tier 2 expenses equal $11,304. Now remember, they received $37,500 of rental income. Let me grab my calculator here. There we go. So far, they have deducted or determined expenses, I should say. Tier 1, $20,500. Tier 2, $11,304. So they're already at $31,804. Now, their final tier for calculation is depreciation. Depreciation on this vacation home is calculated to be $13,939. They are only allowed to deduct 200 of the 230 days. So $12,121, whether you're using the IRS methods for determining rental expenses for a personal/rental home or the tax court's method. The only difference between the IRS method and the tax court method is how we calculate Tier 1 expenses. Take a look. The interest under the tax court method, they use 200 days of rental over a 365-day year. So they're allowing more of the interest, or I'm sorry, less of the interest and less of the real estate taxes as a rental expense. Don't forget, the difference between the $18,000 in mortgage interest and $98.63 that were allowed under the tax court method, that's considered a personal payment and can be deducted as an itemized deduction. Same with the real estate taxes. So how does this all jive out? Of course, they don't have the slide. Take a look on the top of the next page. What are you allowed to expense in the end? Well, under the IRS method, rental receipts are $37,500. So, you can take Tier 1's expenses of $21,500. You could take Tier 2's of $11,304. But you are limited on the depreciation you can take. You can take $56.96 because you can only deduct that last year to the extent of rental income. So when you add up the $20,500, $11,304, and $56.96, it equals your rental income. You also get an additional deduction for the difference between the mortgage interest and real estate taxes allowed as a rental minus the total amount. So that would be $3,000. Under the tax court method, watch what happens. You get to deduct the first tier calculations of $13,068, the second tier of $11,304, and of that total depreciation, you get to deduct $12,121, all of it. In addition, because you didn't take a greater amount of rental interest or real estate tax deduction, the personal portion of those is $10,432. That would be the $18,000 and the $5,000 minus the deductible portion under the tax court method of $98.36 and $27.32. The leftover would be $10,432. So take a look in the increase in expenses allowed under the tax court method. So I encourage you to always calculate under both methods when you have this kind of a vacation home. They use it more than 2 weeks for personal purposes and they rent it for more than 2 weeks. Now what about when you have a property, and this is our next slide, that isn't personal use property? It's rental. You rent it. You use it less than 2 weeks, and the rest of the time it's rented, or the majority of the time it's being used, it's rented. You have to include all the income from the rent, and you also get to deduct all the rental expenses associated with the rental time. Now, if you rent it 100% during the year, or the total use time during the year is rental, well, then it's all deductible, any expenses associated. But as you can see in bullet point 1, if the property is used for even 1 day of personal use, even if it still qualifies as primarily rental, you must allocate between rental over total use. Taxpayers not allowed to deduct the personal use portion of Tier 1 interest expense because the property doesn't qualify as a residence. So you got to be careful of that. Same with the real estate taxes. Or I'm sorry, no, under the real estate taxes you can. Assume the Jeffersons did not use the home for personal purposes at all. They received $37,500 in gross rental income and incurred $40,439. So I call it a pure rental. That's what you're doing. You're renting a property. How much can they deduct? Well, they can deduct all $50,439 and generate a loss on the property. Now you're going to see in the next set of rules we look at, this loss may be limited because it's a a special kind of activity in taxes called a passive activity. And it's exactly what you're thinking when you hear the word passive, just kind of hanging out, just kind of not doing anything. So you're generating income or loss from an activity that is not your main job. It's kind of just something you have there that's helping you out making some money. And it's not from an investment asset. So rental property are generally considered to be in this activity of passive activities, and any losses associated with them are passive activity losses. Here's the rule when you are involved in a passive activity. Losses normally can only be deducted to the extent that you have another passive activity with net income or income. Now, when it comes to rental real estate losses, there is an exception because they don't want to hurt the little guy that maybe rents out the home he inherited and he's generating a loss. You may deduct the loss on your tax return up to $25,000 if you are actively participating in the rental activity. So it may not be your main job, but you're there. You're the one doing the maintenance. You're renting it out. You're the one actively participating in the activities of the rental. Now, there are hours and specific rules for you to determine that. We're not going to get into it right now, but I want you to know that it's just not you saying, oh yeah, I actively participated. You need to be able to prove your active participation. The key here is that you can deduct up to $25,000 of loss associated with the rental activity. However, once your AGI, and this is for any filing status, is in excess of $100,000, they start phasing out that $25,000 maximum loss. And it's phased out 50 cents for every dollar AGI is above $100,000. So let's take a look. Assume in year one, the Jeffersons incurred a $12,939 passive loss from their Scottsdale rental home. They have no other passive activities. Some other passive activities that a taxpayer may own is limited liability or limited partnership interests, and that's a very bizarre thing if you're not in business. What a limited partnership interest is you are basically a partner in a partnership and you're doing no activity in that partnership. It's almost like you're a stockholder in it, but it's not a stockholder because you're a partner. A limited partnership has to have one general partner. They're considered the active member, and they take on the liability. And that's the key. They take on all liability of the partnership. And then limited partners are basically just people who give the partnership money. Well, the partnership, when they make money, okay, or lose money, it's considered for the limited partners, the people just giving the money, a passive activity. It's not considered an investment. It's considered a passive activity. So that is an example of one, and that's why they came out with these rules, because people were just putting money into these partnerships who had the money to shelter or allow huge losses on their tax return, and they were taking them. And then the IRS came out and said, no, passive losses can only be deducted. So any activity that's considered passive can only be deducted to the extent of passive income. So those are your two major ones, limited partnerships and these rental activities. Now, keep going, assume that their current AGI is $120,000. So now they're above $100,000, but they do actively participate in their rental activity. So they are allowed to deduct a portion of this loss. Let's see how much. We take the difference between their AGI, which is 120, minus 100,000. So their AGI is $20,000 more than the phase out. They reduce the maximum loss they can deduct by 50 cents. So the maximum loss allowed is a $25,000. So we're not looking at their loss right now. We're just trying to figure out what's the maximum loss. 25,000 minus that 10,000 phase out. So they can deduct up to a $15,000 rental loss on their tax return against their other income. However, since their rental loss is only $12,939 this year, they can deduct that. They can deduct the entire amount. So we want to make sure you understand you're not deducting that $10,000 from your loss. It's taking off and trying to determine what's your maximum loss because your AGI is above $100,000. Okay, so those are rental properties and some passive activity information. The final area of your chapter deals with office in the home deductions. It's very important we realize that an office in the home, just because you put an office in your home doesn't mean you could take a deduction for it on your tax return. It's generally self-employed people who have their office in their home or their business in their home that are really the ones that are going to be allowed to take this deduction. To qualify for a home office deduction, whether you're a sole proprietor or an employee, so employees may. Let's talk about it. A taxpayer must use her home or part of her home exclusively and regularly as either the principal place of business for your business or a place to meet with patients and clients in the normal course of business. Okay, so if you have a basement like I'm sitting in right now, and one little section you have a desk, that's your whole basement is not your office. Okay, even if this is my normal business place, you actually have to have a portion of your home set apart where all you do is your business. If you're an employee, you can deduct as unreimbursed employee business expenses. Now, when does an employee qualify? If your employer does not allow you to have an office anywhere. So you have no other office. You have to use your home, and your employer is requiring you to use it. I'll give you an example. I had a friend. Her husband worked out of New Jersey. His main office was in New Jersey. They lived locally in Mountaintop. He was a salesman. So his territory was in this local area. So the main office said, just put your office in your home. It's ridiculous for you to drive to New Jersey just to have an office, and we're not going to give you one anyway. So that's what we're talking about here. You need to have an office, and it needs to be in your home. For self-employed people, and by the way, that is considered a miscellaneous itemized deduction if you're allowed to take it as an employee. If you're self-employed, you deducted for AGI, but, and this is key, remember what I said, it's on the Schedule C, and I'm just going to grab a Schedule C where you can take this deduction, and then you can note the line number so that you can check it out if you don't have one in front of you. It will be deductible on line 30 of the Schedule C, so you could reduce your profit that's subject to self-employment tax for this deduction. But here's the key. It cannot create a loss in your business. So you can deduct these expenses to the extent of the profit in your sole proprietorship single member LLC. There's two ways of determining the deduction for office in the home. The actual and the simplified. And the simplified came out a couple years ago. In the actual, you keep track of all your expenses for the home, and then you allocate, just like we did for the rental, between the business portion of the home and the personal, and you base it on square foot. Now, if you have a direct expense to your office, you painted the office, that's a key usually, you did something in the office itself, that expense is a direct expense and is totally deductible. But what about those items to like heat, electricity, if you have water in your office because you have a bathroom, whatever? These are indirect expenses, and you allocate them to the use portion of that office. So you'll say, what's the square footage of my office divided by the total square footage of the home? That's my business use, and that's what I could deduct. So deduction is, once again, is limited to gross income derived from the business use of the home. So Schedule C, net income minus business expenses unrelated to the use of the home. And just like under the rental, when you're personal/rental use, you must deduct them in tiers, just like that. So it would be mortgage interest, real estate taxes, then it would be everything else, then it would be depreciation. And I'm not worried about it. I'm worried about that first bullet where it says, if you take any depreciation for an office in the home deduction and then you sell your residence, remember that depreciation must be subtracted from the original basis of your home. The cost plus improvements minus depreciation. That's what they're talking about there. And I already mentioned it. The simplified method, we love this. If your office is less than 300 square feet of the use of your home, just take 300 square feet times $5 and you get a $1,500 maximum deduction. Well, I shouldn't say if you only use 100 square feet of your home, then it's 100 times $5. You don't get to take depreciation expense. And if your calculation under the simplified method is more than your income, there's no carryover of the expenses. Under the actual expense method, you can carry over any disallowed expenses because of the income limitation. And you can choose each year, so you don't have to pick a method and stick with it. You could use simplified one year, actual the next year. Okay? So that is the office and the home deduction. We don't have an example in there, but I encourage you to take a look. If you have any questions, just make sure you email me or post them on the discussion board. Finally, passive investments are typically an investment in a partnership, S corporation, or direct ownership in rental real estate. Ordinary income from these investments is taxable annually as it is earned. Ordinary losses may be deductible currently if you're able to show tax basis limitation, at-risk limitation, and passive loss limitation. So what is tax basis limitation? This could get very complex, but losses may not exceed an investor's tax basis in the activity. Here's what we're talking about. You spend $2,000 for an interest in a partnership, okay? And you have $3,000 of passive activity income, okay, from another $3,000 of passive activity. The activity, the other passive activity that you just put $2,000 into, so that's your tax basis, reports to you a $4,000 loss. Well, what this is saying is that you're only allowed to take the loss to the extent of your basis, which would be $2,000. How do you increase basis? You put more money in, the item makes more income, or you take on responsibility of debt. How do you decrease tax basis? You're taking money out of the company, or you're deducting losses. We just want to make you familiar with this. At risk, your losses may never exceed an investor's amount at risk. Excessive loss carry forward, your excess loss carry forward until events occur to create additional amount at risk. So what is at risk amount? It's calculated like tax basis. May not include investor's share of debt though. She is not responsible to repay. However, usually includes investor's share of mortgage debt. So as you can see, we're getting a little complex, but we want to make you aware that just because you have a loss from an activity doesn't mean you can deduct it. You've got to look and see, what do I have invested in it? What is at risk here? And that's what we're talking about. So just like my $2,000 from before, how much do I have at risk? $2,000. Well, then I can only deduct $2,000 of that loss this year. So take a look. Lon purchased an interest in a limited liability company for $50,000, and the LLC has no debt. Lon's share of the loss for the current year is $70,000. How much is the loss limited by his tax basis and at risk? Well, Lon's tax basis is $50,000 because of his $50,000 investment. As a result, $20,000 of his $70,000 loss is limited, leaving a $50,000 loss. His at-risk amount is also $50,000 because the LLC does not have any debt. Thus, there is no additional loss. After you determine, can I even take a loss? So let's go back to our example. You have a $3,000 passive income. You have some activity that's passive that is $3,000 of income. In the same year, you have an activity that you invested $2,000 in, no debt, just to keep it simple, but has a loss of $4,000. Well, can you take all $4,000 as a loss? No. First you say, what do I have at risk? I have $2,000. So the maximum loss I can take is $2,000. The next question is, do I have passive activity income? Yes, $3,000. So you can take all $2,000. Okay? What if you had no taxable passive income? Well, then you can't take any of that passive loss this year. So you can see it gets pretty complex when it comes to these passive activities, and that's what they're talking about all through in here. A passive activity, one more time, is a trade or business or rental activity in which you do not materially participate. And to determine material participation, I told you we have rules. In that last bullet, there are 7 factors for testing material participation. So if you can get yourself in as a material participant, you no longer have a passive activity. And there they are. So read through them. You can see they're very specific. And there's the loss limitation. Going back to Lon, can he deduct any of it? Generally, the income from rental real estate is considered to come from a passive activity, so he can deduct $5,000 of his passive activity loss of that $50,000 against the real estate activity. He must carry forward that $45,000 passive activity loss until he receives more passive activity income. Lon is able to deduct $5,000 of his loss, and he has a $20,000 tax basis, and at-risk carry forward, and a $45,000 passive activity loss carry forward. So it gets crazy, huh? Here is another example. Just because I'm running out of time, take through it. Please, if you have any kind of questions, please make sure you email me.